Well, good afternoon, and it does seem very appropriate to be here in Tokyo talking about G20 priorities just ahead of the weekend's ministerial in Fukuoka. And happily, we've got the right people for the job here, all of whom have experience in global governance and in the private sector. So that's exactly the nexus we're looking to hit here today. This is for the IIF, our 11th G20 conference, and we're very honored to be co-organizing this event with Japan's G20 team. And every year we've had a panel like this, offering private sector perspectives and support to the G20. The question is, are we having an impact? And I would argue that Japan's G20 presidency is making a really determined effort to tackle some of the biggest challenges the G20 has ever had. Yes, of course, there were fires to put out during the financial crisis. We remember central bank swap lines, special liquidity lines, coordinated rate cuts, all that fun stuff. The euro area sovereign debt crisis brought its own set of problems, post-crisis financial reforms. But the threats to multilateralism we've been discussing over the past 2 days might make those seem like the good old days, really. And recent years have also seen a big G20 focus in areas like sustainable growth, addressing infrastructure gaps and financial inclusion. And Japan has put global public goods, so including healthcare, social equity, and the environment, high on the G20 agenda. And you may have noticed in the last couple of days there's been a big push for agreement at the G20 summit in Osaka on the reduction of plastic waste inflow into the ocean to zero by 2050. That's quite ambitious. You can add debt sustainability to the list, an area where the IIF and its members are helping with a set of new principles for debt transparency, so more on that later. Japan's also had the foresight and the guts, really, to take tough questions like what to do about rapidly aging populations, all while shoring up the global trading system and rescuing multilateralism, so piece of cake, really. So 3 big issues for our panelists today. Number 1, how can the G20 find opportunity amidst this tribalism and trade wars and rebuild support for economic cooperation? Number 2, what can the international financial institutions and other global groups do to help? And finally, how can we do a better job of channeling private sector funding for what are really public sector goods? So Reza, I want to start with you here. Most of our panelists at this conference have been pretty downbeat on prospects for the global trading system, unsurprisingly. You spent many years in a very pivotal strategy role at the IMF. So how do you see a plausible path back to multilateralism?
Thank you, Sonia, and great to be here. Thanks for the invitation. I think we are at the G20 and at IIF, both of them multilateral institutions. So I think it's probably not wise to talk about the end of multilateralism where we are in the middle of it here and G20 and IIF making progress. And also having spent most of my career at a multilateral institution, I cannot be pessimistic about multilateralism. I think there are periods where multilateralism is in recess, but at least my experience has been it will make a comeback. And let me just elaborate on that. I think the reason is twofold. First, many of the issues that we currently face, many of the challenges that the globe faces are very much multilateral issues, whether it is climate change, whether it is adequate safety net for in times of crisis, whether it is technological change and the use of data across borders, or cybersecurity. These are not issues which are easy to solve at the national or even bilateral basis. They need to be talked about in a multilateral setting. Many of them are on the agenda here this weekend. Secondly, I think my own experience of what I saw at the IMF, I remember in 2007, 2008, reading articles in the leading newspapers of the world talking about the end of the IMF and the need to downsize it enormously, just focus on data. There is no need for lending. There is no need really for surveillance. The markets will do that. And as a result, we downsized considerably. The staff were reduced by 20-25%. The focus of the work was narrowed. But as soon as there was an international crisis, as soon as there was a multilateral need for discussion, the IMF was back, resources were tripled, the focus of work was widened. There was also reform of the way the institution ran. So these things go in the cycle, and I am sure there will be return to multilateralism when it is clear that some of these issues that need addressing are multilateral issues, or in a not such unlikely case that we face global challenges and possibly crises that are not unlikely in this world of large capital flows. So it is true right now at the G20, probably the focus of this meeting would be a bilateral meeting between two presidents rather than the agenda, the focused and good agenda that the Japanese have put together. But think of what happened after the last crisis. Multilateralism came back with force. G20 in its current form did not exist before this crisis. FSP did not exist before the last crisis. So if anything, the pillars of international multilateralism were increased, and many of them, people are not questioning the role of IMF anymore. It is true, World Bank has many other institutions like AIIB in the same area, but there is a degree of additionality, not substitution or reduction. And so I think the trend has been, it is true right now in terms of trade, the role of WTO is being questioned, but I do not see questioning of the other multilateral pillars of the international system. And I think the focus on them over time will come back, depending on the circumstances, certainly because of some of the issues that the world will have to deal with.
That's really nice to hear a more optimistic take on this. It's quite a contrast to some of what we've been hearing over the past couple of days. Thank you. And maybe, Keiko, you too can give us a glass half full on this, or an optimistic slant. So when you think about, the idea of channeling more private money for infrastructure and other sustainable development goals, it involves an awful lot of risks, right? And the need for risk mitigation, not just credit risk, there's project risk and breach of contract, political risk. What can the NDBs, and specifically MIGA, do to help?
Thank you, Sonia, for great questions, and good afternoon to all of you. Thank you very much for having me here. MIGA may not necessarily be well known. Thank you very much for the opportunity to just showcase what we do. MIGA is a multilateral investment guarantee agency. We are part of the World Bank Group, so we are also multilateral. But we were set up, we're probably one of the youngest MDBs. We were set up about 32 years ago. Our mandate is to create development impact by bringing cross-border private investors or increasing FDI into the developing country by mitigating non-commercial risks. So what the non-commercial risks? Those are breach of contract by the governments, expropriation, currency incompatibility and transfer restrictions, and warrant civil disturbance. So those things, unfortunately, do happen sometimes. But our job is to making sure our private investors hitting those risks. By the way, the probability of a private investor hitting those risks is about 15%. Since we support a lot of lower-income countries or fragile conflicted states. So we work with the private investors to solve the problem with the host government. So therefore, investment will continue. So that's what we do. And if I may add a couple more points. First point, if you ask, is MDB's role is changing? My answer is yes. MDBs was set up about 72 years ago to provide the advices and financing to developing countries. In addition, We started through the additional mandate given to IFC and Omega and World Bank Group. We are mobilizing private capital, or I think vast majority of you here in this room are private investors, probably not that many from the MDBs. We are supposed to help you to mobilize your money. So therefore, developing countries can enjoy not only the financing from you, but also the private solution. I think most of you are grown up in multilateral world, now moving into private. I'm like only here, moved from the other way around. I've been in a private world for, I don't call the number of the years, but quite a bit. And I moved to the MDB about 6 years ago, but I strongly do believe what private investors, you in this room, can do is actually huge. So we actually like to work on that. As a matter of fact, I think one positive spin. Last year, G20 Eminent Persons Group, led by Tarman, made the announcement, I think in your Bali meeting, what they expect us to do to the MDB. One of these statements listed in their report, I'm sorry, I forgot the name of the report, but anyway, I think the report essentially asking MEGA to, name of the report is Making the Global Financial System Work for All, in case you want to Google it. But they're asking MEGA to support all MDBs so that MDB as a system to mobilize more private investors. So I hope that's answered to your question.
That is a very good answer to your question. Making the financial system work for all and making Stuart's job easier, right? Stuart, when you're going into these riskier places, Keiko's there to help. So, but let's get down to brass tacks here. We're talking about public-private partnerships, risk mitigation, blended finance, and so on. How are these arrangements working in practice? Are they working out well? What can be done to make them work better?
I'm very positive, actually, at the progress that's being made. I mean, Reza, you talked about the need for multilateralism. I mean, sustainability issues, the work in low-income countries, etc. They're classic collective action problems that require not just international approach, but also a collaborative approach between the public and private sectors, because the funds available in the public sector alone will never be able to tackle some of the issues we have, particularly in infrastructure gaps where we're using blended finances approach, etc. And I've seen, since I came into this job, a real uptick in the sort of problem solving, if you like, about the steps, the things that are needed to be put in place to make this successful. So, for example, there's a lot of work going on, and it's generally accepted that if we're going to meet Paris targets, then all the infrastructure that needs to be built has to be built in a sustainable way. And of course, we've got the Equator Principles. Japan's G20 presidency will be bringing out a definition, if you like, of what quality infrastructure needs to look like. And even in the Belt and Road Summit in April, we saw an effort for greening the Belt and Road through green investment principles for Belt and Road. So there's a lot of activity which, although it's maybe going on in different places, I think will become increasingly coherent and give us a definition of what sustainable looks like in the infrastructure space. There's also a lot of activity and a sort of consensus on some of the standardization that would be helpful in debt contracts and disclosure arrangements around infrastructure, etc. All of which, again, will help attract investors in. And then two, moving away from individual infrastructure projects, there's a lot of progress on securitization of these assets and the sort of information that one needs to be able to pool these assets and again bring in a different class of investors. So when I put all that together, I kind of feel that the menu of things that need to be done is there. There's still progress to be made on most of it, but we're getting there. I add to that blended finance, this mixing and risk sharing between public and private sector, where I really congratulate the MDBs for the steps they've taken over the last few years to simplify many of their credit enhancement and guarantee products, make them easier to use, and also to coordinate a little bit more on that. So that's impressive. If I look now and I say, well, what really are the roadblocks? What is now going to make the money flow into these projects? The part that I tend to come and focus on now is whether the pipeline's going to be there. We've got a lot of interest in asset owners who are looking to be part of the sustainable agenda while getting the returns. The intermediation is gradually, I think, being sorted, but we need the product. And one of the things that I would like to see, because there's lots of efforts in capacity building, etc., but is somehow just to get a little bit more focus on making sure we get bankable, investable products, in the countries that most need it, being brought to market. So I'll try this for you, Kyoko, if you'll take it. But the World Bank Group has for some time run a Doing Business report, which was tremendously successful at motivating countries to put in place the right sort of business environment that would attract inward investment. And I wonder whether we could do something like that in the infrastructure space, a Doing Sustainable Infrastructure report that gave a very clear roadmap to countries on what they need to do to put in place the policy environment that's then going to make that financial intermediation work. So that's the sort of thing that I think we need to concentrate on now.
Well, I've spoken like a true policy person, and Keiko, nice to see you're taking notes there. I guess you've got all Stuart's recommendations down.
HSBC is a very important client of us, so I'm taking notes.
So, Isabel, we've been talking a bit about kind of the MDBs and the lending side of the picture, and Stuart mentioned the demand from asset owners and, of course, the asset managers for sustainable investments. So, some, though, are still arguing that sustainable investment means giving up returns, and it might be a breach of fiduciary duty if you're doing subpar returns. How do you go about sort of integrating climate and ESG factors into your kind of strategy and asset allocation, and in the context of a traditional returns-driven investment?
Good afternoon to all. Thanks very much for the question, Sonia. It's great to be the last to speak and yet still have things to say, because not everybody has been exhausted. First of all, this question of sustainable investing and channeling investment to the promotion of sustainability is an area where I think excitingly a lot of change has happened in recent years, despite remarkably little help from the multilateral system, which is encouraging, because I think now there is more of a desire from the G20 and others to give more impetus to this change, and so we would expect to see a further acceleration. But by and large, over the last 6 years, we've seen almost a doubling of assets managed according to environment, social, and governance criteria. We're now closing in on $800 billion globally, and that's a massive change that has happened, again, with remarkably little incentive. The market has grown from being essentially just a green bond story to covering absolutely all asset classes, from plain vanilla cash to hardcore renewable power infrastructure, with every asset class in between, government bonds, corporate credit, equities, starting in the US, but increasingly everywhere, emerging market debt. So you can now implement these strategies across an entire portfolio. And what's very interesting in the demand that we're seeing from asset owners is that initially the ask was about, I'd like to do something in my portfolio to make it more green or more governance friendly or more socially friendly. And so products were created to that effect, to satisfy that demand or to exclude particularly controversial types of investment. Increasingly, we're seeing clients tell us, I want to change my entire bond portfolio wholesale into an ESG version. Same thing with equity. So the idea is really to mainstream the application of these environmental, social, and governance consideration in portfolios. And that's a great source of pressure. And fortunately, because now all the financial instruments are available, it's becoming easier and easier for portfolio managers to actually implement these criteria in their own strategies, some of them with an explicit ESG label. But increasingly, the research that our portfolio managers are doing suggests that taking these criteria into account is a source of alpha. So not only are you not sacrificing return, but you're actually able to generate better risk-adjusted returns by taking into account environmental, social, and governance considerations. Now, the emphasis will vary depending on the geography, depending on the teams. Here in Japan, we have a whole strategy that is based on governance, focusing on companies with good governance, which is quite innovative. But the point I want to make is I think we're well beyond this idea of, or there's a trade-off between, doing good and doing well. If you're a serious investor, you now have everything you need to be able to do both at the same time. So what's missing, and what can the public sector do to help that industry grow further? A couple of things. The first one is this whole ecosystem has grown in a very decentralized way. So yes, we have the Paris Treaty and the Paris Goal, but every country is going about implementing this strategy in a very decentralized way. So the market, unfortunately, doesn't have the scale that it could have, because in each country, what you mean by sustainable or by green or by this or that is different. And that obviously slows down the growth of the sustainable investing industry. Second thing the multilateral partners could do is lead by example. Which was frankly missing until very recently, because public asset owners, including central banks and sovereign wealth funds, I guess felt that this wasn't their remit to promote sustainable everything, and I think there's been a sea change there, frankly, in the last 12 months, where we've seen central banks and financial supervisors organize themselves in a network to green the financial system, and recently coming up with a paper which I found very encouraging in the sense of acknowledging that yes, they too have a responsibility in their activities, either as supervisors or as asset owners, to do what they can to promote a more sustainable financial system. Likewise, sovereign wealth funds are increasingly organizing themselves in various fora to compare notes, to compare research on what is the right way to incorporate these sustainability considerations in what they're doing. And sovereign assets, if you include both wealth funds and central banks, pension funds, are close to $100 trillion. So this is a lot of money there. If all this money starts being managed in a way that is more consistent with sustainability, it will be a game changer. So that's the third thing I would say that the official sector can do. And lastly, and this is beginning to happen in different countries, but again in a very decentralized, dispersed way, is incentives. And by that I mean, setting prices right. Decarbonization will happen a lot faster if carbon-heavy activities are penalized compared to others. And again, this is beginning to happen. But the more the financial sector gets the message that this is the direction of travel, the more it will make economic and financial sense to move away from these activities in portfolios, etc. So we've come a long way. We're very bullish on the prospects of sustainable finance generally. We think it's going to continue to grow very fast, but this is an area where the private sector has to a large degree been in the lead, moved by itself, and there's a lot that the official sector can do to accelerate this progress.
It's interesting, and I might just stay with you for a minute, and maybe you too, Stuart, as well, because we have an interesting question that touches on what you were mentioning there. And so the question is, you know, there is a need to, in terms of stewardship, you need to engage with companies, and some of these companies will have fossil fuel revenues. So at what point should financial firms say to a client company, our government's principles don't align with your business model? And some European banks, for example, have a 5% threshold. So if you have thoughts there, or you, Stuart, it's an interesting question.
Yeah, I mean, you're right. The logic of this is that as we transition to a low carbon economy, if you have large clients who don't get the program, don't appreciate and respond to the risk to their business model, then at some point they're likely to find themselves outside the risk exposure of the finance industry. But that's not, of course, the outcome that we want. I mean, we're going through a process at the moment, just to sort of give you an idea of how mainstream this is becoming, the issue of sustainability, where we're getting an increasingly granular sort of fix on climate-related risks and how to integrate them into our credit risk modelling, and ultimately through to, you know, our credit decision processes. And one of the ways we do that is by having a dialogue with our major clients, you know, who are most likely to be affected by the switch to a low carbon economy. We talk about the environment they operate in, the policy change in their particular region or countries that might be down the tracks, their sort of vulnerability of the sector that they're involved in, exposure to technological change, or that their very products and services may, you know, may suffer a precipitous fall in demand. And, you know, together, so we come away from that discussion, along with also a lot of work we're doing on attributing CO2 exposure, another issue, but we come away from that discussion and with these other things we're doing with quite an increasingly good fix on how we judge the climate-related risk of that client. They come away also with an understanding of some of the challenges they face. Of course, many of them already have that appreciation, but also we look at it collectively. So rather than saying, you know, get with the program or we'll drop you off, we try and ensure, of course, that we're all moving in the same sort of direction together, but with the same appreciation of the risk to the business model that they face. And just to pick up on a couple of points that Isabel made, I mean, I think the beauty of the TCFD and the reason for the TCFD was there was this scatter of many global initiatives on how to on carbon disclosure or climate-related disclosure, and the objective of the TCFD was, of course, to sort of gather these together, take the best of them, and develop an approach that would get real currency globally, and that's worked. And I think you're right in all these other sort of definitional questions, etc. We need somehow to have some organising framework that ensures at the very least coherence between the way these definitions of what's sustainable and what's not are developing regionally. The thing is, which body is the most appropriate one to do that? It's quite a difficult question, because, well, with the TCFD, of course, there was a financial stability risk, so the FSB could take it under a G20 umbrella. Yeah. That's not necessarily the same for some of the other questions that are under consideration.
But there's a role here, I think, for multilaterals. And Keiko, I was going to come to you on this question. When you think about sort of structuring impact investing and measuring impact and so on, the World Bank and IFC have done a lot of work in support of impact investment and also sort of gender equity type issues. So do you want to describe a bit of that?
Okay, well, thank you very much. I completely agree with Isabel. I think institutional investors, both of the institutional investors has been going up from achieve high risk-adjusted return to, in addition to achieving high risk-adjusted return and being responsible, then I think that responsible definition, it seems to be moving. And an impact investment is a kind of great, sounds great, but the question is what the impact investment means. That's why a broader institution called IFC decided to take a read to define it. What the impact is one dimension. Another dimension is what the responsibility. I think impact investment side, I don't really kind of want to talk about it, but I think responsible side, I just like to highlight. About 40 plus institutions, including us, signed on IFC's Impact Investment Compact. But the responsibility side does include the very detailed how to do the due diligence of environmental, social integrity side, plus monitoring of the investment annually. As a matter of fact, IFC's current Impact Investment Compact does require not only the sample monitoring, but also have to monitor every single project. This will take time and cost. And I am not exactly sure how many institutional investors can pass on those costs to your ultimate clients.
Difficult questions. Stuart, let me come back to you for just a minute here. No, actually, I'm going to come to you, Reza. The G20, they've certainly championed environmental and broader ESG issues, and one expression has been the very fast-growing central banks and supervisors network for greening the financial system, Isabel mentioned. So what role do central banks play in addressing ESG risks, and can the NGFS affect real change?
I think in answering that question, let me just emphasize a couple of things which have been mentioned. First of all, my own experience from where I sit in our bank is also that the demand for investing in ESG products is extremely high, and not just from large asset investors like the one Isabel represents, but it is very, very broad-based. Large and small asset holders are interested in this. Secondly, so the demand is unfulfilled at the moment. So the potential is there, it's not fulfilled right now. Secondly, the market is very fragmented. I think what you mean by ESG or simply green bond may be different when you go across borders. So coming to your question, the network for greening of the financial system that has been set up by the central banks, it can play that role in terms of, for example, facilitating the improvement of the market by having definitions and agreements across the border that could be helpful to asset managers who invest globally rather than simply locally. Now, their focus, understandably being central banks, is also on mitigation and disclosure initially. That has been a big part of what they have produced so far. We, for example, in London, are being asked by Bank of England to look at our balance sheet, look at our various exposures, and not an easy job, tell them what would be the impact of climate change on our balance sheet and how we will mitigate the risks.
How come that's not easy? That sounds
it's
like
not
an
so
easy
easy,
task.
but the central bankers are focusing on this, and as you know, for example, Bank of England is very active in the steering group of the network for greening of financial. So that has been the initial type of work they have been doing, and it's understandable, it's within their mandate. But I think increasingly they are looking at facilitation in terms of definitions, and also they are large asset holders themselves. One thing which has struck me when dealing with the public sector is the governments are very keen on green investment. They are increasingly keen on issuing ESG bonds themselves. But some other parts of the public sector, for example, as the debt managers who have to manage the process, they are not as keen on it because of the difficulties in the process. So I think something like NGFS could help facilitate the acceptability and practice in the public sector, and enable the work in the private sector to have better standards and easier transmission across borders. And finally, we started by talking about multilateralism. This is very much a multilateral effort. The steering group is from all continents. The US is not represented, but the vice chair of the Fed is the chair of FSB, so there is some coordination through that, but the representation is very much across the globe, and unfortunately the US is not at the table directly.
So a bit of Isabel's point to leading by example. So good role for central banks there. We have another interesting question from our audience, and essentially it asks, Europe has kind of been in the lead on this, European financial firms and so on. How does the rest of the world catch up? Non-European institutions.
Maybe I could. Oh, okay. No, if I can just express a thought on that as a representative of an American company, I'd say it's the European asset owners who have been ahead of the game on this, who have been putting pressure on the likes of us to make new products available, to essentially reset the baseline. When you start having some of your biggest clients saying, I will not invest a penny into these products unless you exclude, heavy revenue exposure to fossil fuel, controversial weapons, and whatever else, it becomes economically and financially sensible to just apply these kinds of filters across the board. So I think what's been happening in Europe is that a critical mass of asset owners have been taking these issues very, very seriously and forcing the entire industry to move along. Before leaving that point, if I could just go back to the point on corporate stewardship that you raised earlier. This is something that we take very seriously, because a very large fraction of the assets that we hold on behalf of our clients are held in passive, so-called passive vehicles, meaning we can't sell the stocks when we don't like the way the company is run. The only thing we can do is engage with the management and the board of the company. And this is something that we've been devoting an increasing amount of resources to. And this question of sustainability of the company's practices, not just certainly when it comes to environment and exposure to risks of climate change, or exposure to risk of climate regulation, is becoming a more and more important topic of engagement in these stewardship conversations. And ultimately, we always prefer to engage, but increasingly, when we don't get the response that we expect from the management or the board of a company, we end up voting against as a last resort. But this is really an area where we feel the industry has the power to change corporate practices well beyond the financial sector.
And Stuart, you wanted to comment?
Well, just very quickly, I'm not sure it's quite true. Europe, of course, is advanced in its thinking and has, through the European institutional, a very formalised process for taking forward its policy thinking, the high-level group, etc. But don't forget Asia, because this, issue in Asia with air quality, etc., rose very high up the agenda in China, and China itself was one of the first governments to really take very positive action on the sort of financial system side, with a collaboration between 9 ministries to produce the greening the financial system sort of roadmap a couple of years ago. And they've created a Green Finance Committee to ensure that the financial system there is developing in accordance with that. Likewise in Hong Kong, there's a big effort there on the part of the authorities as well as the sort of trade bodies of the financial sector, to make that a sustainable finance centre. And all these exercises, whether it be mainland China, Hong Kong, and increasingly Singapore, are looking at these taxonomic definitional issues. They're setting policy, and they're also looking at the development of their markets. And in the case of Hong Kong, they intend to mark the major financial institutions that operate in Hong Kong against a framework yet to be designed, whether they're doing well enough in terms of their performance and sustainability. So there's lots happening outside of Europe in this space. And one of the challenges, of course, is to make sure it's coherent.
Yeah, and maybe aligning some of these approaches so that you can scale up the market more effectively. Keiko, thinking about kind of support for sustainable growth and so on, one important way of doing this is by bridging the digital divide, making sure that everyone has access to information and communications technology. And I know that's something else that the World Bank has been focused on.
Yes. Well, digitalizations often support developing country to leapfrog. That's, you can see it, the money transfer system in Kenya. Mm-hmm. By the way, I don't know how many of you know that there are more mobile phones in this world than a toilet.
Really?
Yes.
Well, that allows you to drop some of them down there without worrying about it.
We need more toilet. This is the theme of the Gates Foundation, but I think this is not an agenda of you and I today, so just set aside. So, 7 out of the 10 people in the world now have a mobile phone. Theoretically. Of course, many of you have 2 phones, so therefore some of the people in Myanmar and Mali may not really have it. But mobile phone penetration is amazing. But of course, we need a power for mobile phone to be used. And we also need to increase the quality of mobile phone line. Also, we have to kind of bring in more broadband. Therefore, we really need to work on. But I also have to tell you one thing. This mobile phone or the broadband is the one area it's really suited for the private investment. Do you know why?
Good returns?
Well, ultimate beneficiaries are willing to pay. Uh-huh. And they don't expect government to subsidize. So that's why we are supporting private investors going into the country like Myanmar, Mali, Central African Republic, Sierra Leone, and so forth. And I think those people are making a very sounding return because you can also terminate the phone line, which is not going to be creating so far a lot of problems. But if you terminate water supply, if you terminate power supply, sometimes cause a problem as a private investors. So that's, I think, there are a lot of private solutions are very efficient and effective in this area. That's why I have very positive about this, the path to solve this digital divide. Mm. And at the same time, private investors also can benefit.
I like this panel. A lot of, solutions rather than just focusing on problems. This is really good. However, I'm going to turn to a tougher topic now, move from sustainable finance to debt sustainability. It's a little more intractable here. So, Reza, coming to you first again. We've been talking about sustainability considerations, and one element of that is clearly debt sustainability, which has been a big G20 issue this year. So given the big increase in global debt levels over the past couple of decades, where do you see the biggest risks in debt sustainability?
First of all, let me commend IIF for producing very good information on debt, both public and private. So it's a good basis of analysis. I would say, first of all, debt is not necessarily a bad thing. It depends what it is used, and given the needs for investment around the world, the need for raising capital and therefore incurring debt is there. And that has become more available, and given where interest rates are globally, it does make sense in many cases to borrow, whether you are a corporate or or a government and invest. The question is what kind of investment, what kind of rate of return, is that higher than the long-run interest rates that you have to pay? So at the outset, we should not necessarily think it's the bad thing. And also in this environment, of course, it's more sustainable given that the interest rates are very low. However, you can run into a problem, and that's the focus of the G20 here. And I would look at it from two perspectives. One is the type of country that or corporate in that country that borrows. And secondly, first the type of country, whether it's an emerging market, advanced economy, or developing. And secondly, who else borrows apart from the government in the country, and in what terms and how. So I think you have to look at both dimensions in order to make an assessment of are you facing a problem or not. Now, in terms of the advanced economies, debt has gone up in part as a result of the crisis. And so the emphasis has been generally, not universally, but generally on fiscal consolidation and therefore managing debt. Why? Because you may need to use the fiscal space in the future. But again there, I particularly underline, when interest rates are lower than your growth rate, it is not necessarily wrong to borrow, but you obviously have to think of long-term repayments. Emerging markets in this, in the last 10 years since the crisis, having learned from the past the experience of the crisis, they have obviously relied more on the domestic market, more on domestic debt. External debt, as your numbers in IIF show, have gone up a lot, but from a low base. So probably the concern there, again, would be on individual countries that have exhausted the room, or they have run up a lot of room. And in some countries, the focus has to be on the private sector. So if you compare Argentina versus Turkey, in Argentina, obviously, it's a public sector issue, but in Turkey, despite the exchange rate being under heavy pressure, it is not because of public debt, it's because of private debt, and the transparency of that, the terms of that, and the pressure that puts is an issue which is very important. Finally, I think where there is a concern is in some of the developing countries, where the availability of capital, both from the markets and from new bilateral lenders, has gone up a lot. Now, both the capital markets have a responsibility, but also there is a responsibility in the multilateral system and on individual lenders in terms of transparency to be able to assess debt sustainability. And I think that's a big issue. For example, if you look at what the IMF is looking at, a lending program in Pakistan, for sure, the issue would be a comprehensive debt sustainability analysis, not simply the capital market borrowing, but also the bilateral borrowing, the terms of that borrowing, and the sustainability of that borrowing. So I think there's an issue of one has to look at the details, one also needs transparency from the new lenders, and so I think it's not an issue of good or bad. One has to put it in that context in order to make an assessment and judgment.
Well, thank you, Reza. You've set Stuart up beautifully for the question that comes to Stuart next, which is, in terms of what the private sector can do about debt sustainability problems, you and I have been hard at work, and the rest of IIF members, on a set of principles for debt transparency. How's that going to help?
Well, thank you. I mean, I think it's gone very well. We have a vested interest in the private sector. We like to be paid back, and we get into trouble if we're not. But also, when there's a large-scale event, we're on the hook too when there's a debt restructuring or write-offs. So when there's a concerted attempt to foresee problems coming up, particularly with the low-income countries, as you talk about, Reza, then it's sensible, certainly, that the private sector plays a role too. And so, for those that don't know, there's been a lot of work going on some disclosure principles, essentially, where this is focused on low-income countries, and there's a sort of key features, if you like, of the lending arrangement that would be disclosed and made transparent sometime after the lending arrangement is agreed. And the aim of this is to have data out there that will help actually increase the flow of credit to those countries that need it, but also improve the basis on which debt sustainability analysis is carried out. So we're, I think, in certainly technical agreement on the way these principles should look, and Tim Adams will present them, I think, to the G20 tomorrow, which is great. There are still some important issues that need to be worked out with these principles. For them to be effective, of course, it's no use if IIF members adopt these, but the credit simply flows around them. There's some sort of arbitrage, and we need to ensure that they do in fact contribute to better debt sustainability and the analysis of that. And the borrowing countries themselves need to feel that this isn't being imposed by the private sector, but is part of a collaborative public-private effort under the G20 for it to have legitimacy. So our hope is that the recipient of this information will be an organisation like the fund or the bank, because that immediately gives it the legitimacy that it requires, with the borrowing countries being board members, which hopefully would reduce any chance of arbitrage. And it also feeds then directly into that debt sustainability analysis. So, watch this space, and we'll see what the G20 has to say about it tomorrow.
Well, we're coming close to the end of our time, but Isabel, maybe just quickly from you, investors and bonds and other types of investors have been a much bigger part of the credit base for some of these low-income borrowers. More transparency is going to help you with your job and credit assessment and so on?
Yeah, I think that's an essential element of the plumbing factors that Mark Carney was talking about last night. One of the side effects of all the efforts to make the banking system safer has been the need for everybody to rely more on market-based finance, and that's neither good nor bad. That just is. But as a result, the transparency, the data flow on things like debt burdens is not as readily available. And I think all these kinds of efforts to put as much transparency as possible on what are actual debt profiles and debt maturities is essential for market prices to reflect actual levels of risk. So yes, we're fully supportive of these kinds of effort. But of course, it won't eliminate entirely some slightly perverse incentives that can be at play, for example, in the most recent period, because there's so much uncertainty in the global environment. We've seen a renewed appetite for dollar-denominated debt, with a resurgence, really, of borrowing in foreign currencies by emerging markets, and that's going to increase their risk profile, unfortunately, as we go forward. But this is just the nature of market risk appetite when there's so much uncertainty in the air. So these plumbing questions are key, and transparency is certainly a good place to start.
Well, I want to thank all our panelists for really thoughtful answers to tough questions. Glad we've solved all this and worked it all out. So thank you very much. Please join me in welcome.